When I was 24, a coworker asked me what I was invested in. I said, I have a savings account. He looked at me the way you'd look at someone who told you they were training for a marathon by occasionally walking to the mailbox. He wasn't trying to embarrass me. He just assumed, reasonably, that a grown adult with a full-time job understood the difference between a stock, a bond, a mutual fund, an index fund, and whatever else people were talking about when they said the market. I didn't. Not really. I knew stocks existed. I knew the market went up and down. Beyond that, it was static. Words I'd heard 1,000 times without ever being taught what they actually meant. And here's the thing that bothered me later, once I finally learned this stuff. Nobody ever sits you down and explains it clearly. Not in school, not at most jobs. You're just expected to absorb financial vocabulary by osmosis. And if you don't, you quietly assume investing isn't for people like you. It is. All of it. Every single type of investment I'm about to walk you through in this video is available to a regular working American with a regular brokerage account. None of it requires a finance degree. None of it requires being rich first. What it requires is someone actually explaining it to you in plain language, which almost never happens. So, that's what this video is. Every major type of investment that exists, explained the way I wish someone had explained it to me at 24. What it is, how people actually make money from it, what the real risk looks like, and whether it belongs in a working American's portfolio in 2026. By the end of this video, when someone asks you what you're invested in, you're going to actually know what they're talking about, and more importantly, you're going to know what's actually worth your money and what isn't. Let's go through every single one. My name's Chris. Welcome back to Chris Finance, the channel that explains money the way it should have been explained to you the first time. Subscribe if you're new. New videos every week. Today we're covering every major type of investment that exists, 11 of them. Plain language, real numbers, no jargon left unexplained. Let's get into it. Investment number 1, stocks. When you buy a stock, you are buying a small piece of ownership in an actual company. Apple, Coca-Cola, Walmart, Microsoft. When you own a share, you genuinely own a tiny sliver of that business. Its buildings, its products, its future profits. How you make money from stocks? 2 ways. First, the value of your shares can grow as the company grows. If you bought Apple stock and Apple becomes more profitable and more valuable over time, your shares are worth more. Second, many companies pay dividends, a portion of their profits paid directly to shareholders, usually every quarter. You can hold the stock and collect a regular check just for owning it. The real risk. Stock prices move, sometimes wildly. A company can report disappointing earnings and drop 15% in a single day. A CEO scandal, a product failure, a shift in consumer taste, any of it can hit a single stock hard. This is called company-specific risk, and it's the reason owning 1 or 2 individual stocks is far riskier than owning a broad collection of them. There's also a behavioral risk that I talked about in my S&P 500 video. I lived this one personally. Fear and greed make people buy stocks when prices are already high and excitement is everywhere, then panic sell when prices crash and everyone else is scared too. That emotional cycle is responsible for more lost wealth than almost any market crash itself. Bottom line for working Americans, individual stocks can be part of a portfolio, but should usually be a small slice, not the foundation. I'll explain why index funds solve most of this risk in a few minutes. Investment number 2, bonds. If stocks are ownership, bonds are lending. When you buy a bond, you are loaning money to a government, a city, or a corporation. In exchange, they promise to pay you regular interest, called a coupon, and return your original investment at a set future date called the maturity date. Think of it like this. The U.S. government wants to borrow money to fund projects. You buy a U.S. Treasury bond. The government pays you interest twice a year for the life of the bond. At the end of the term, say 10 years, they hand you back your original investment in full. How you make money from bonds? The interest payments are predictable and scheduled. Bonds are considered the more conservative, steady cousin of stocks, less exciting but far more predictable. The real risk. Bond returns are typically lower than stock returns over the long run. You're trading growth potential for stability. Bonds are also sensitive to interest rates.
When interest rates rise, the value of existing bonds tends to fall because newer bonds being issued pay higher rates, making your older, lower-rate bond less attractive to sell before maturity. Not all bonds are equally safe. U.S. Treasury bonds are about as safe as an investment gets. Corporate bonds carry more risk depending on the company's financial health. Junk bonds or high-yield bonds pay more interest, specifically because they come from companies with weaker credit and higher default risk. Bottom line for working Americans, bonds become more important the closer you get to retirement. They're the stabilizer in your portfolio. I covered this in the S&P 500 video when I talked about shifting your allocation as you age. Investment number 3, mutual funds. A mutual fund pools money from thousands of investors and uses it to buy a collection of stocks, bonds, or other assets, all managed by a professional fund manager who decides what to buy and sell on your behalf. Think of it as hiring someone to build and manage a diversified investment basket for you instead of building it yourself. How you make money from mutual funds? When the underlying investments in the fund grow in value, your share of the fund grows too. Many mutual funds also distribute dividends and interest income back to investors. The real risk. This is the category where I want you to pay close attention because it connects directly to something I covered in the S&P 500 video. Actively managed mutual funds. Funds where a human is actively picking what to buy and sell, trying to beat the market, charge management fees, often 0.5% to 1.5% per year. And remember the statistic from that video, roughly 94% of actively managed funds fail to beat a simple S&P 500 index fund over a 20-year period. You're paying someone extra to very likely underperform a fund that costs almost nothing and requires no human judgment at all. Bottom line for working Americans, mutual funds aren't inherently bad, but check the fees and the track record carefully before choosing an actively managed one over a low-cost index option. Investment number 4, index funds and ETFs. If you watched my S&P 500 video, you already know this one, but let's make sure it's crystal clear here too, because it's the foundation most working Americans should build their portfolio on. An index fund is a fund that doesn't try to beat the market, it simply matches it. An S&P 500 index fund buys all 500 companies in the S&P 500 in proportion to their size and just holds them. An ETF, exchange-traded fund, often tracks the same kind of index but trades throughout the day on the stock exchange like an individual stock, giving you more flexibility on when you buy and sell compared to a traditional mutual fund, which only trades once per day after market close. How you make money? You grow alongside the broader market. When the 500 largest American companies grow in value collectively, which they have done with interruptions for the past century, your investment grows with them. The real risk. If the overall market drops, your index fund drops too. There's no manager trying to dodge a downturn. You're exposed to the full ups and downs of the market, but historically, those downturns have always recovered and the long-term trajectory has been up. Some ETFs are narrow and sector-specific, focused only on technology, only on energy, only on a specific trend. Those carry more concentrated risk than a broad index fund. Stick to broad market funds unless you specifically understand why you're taking on that extra concentration. Bottom line for working Americans, this is, in my opinion, and Warren Buffett's, the single best foundation for almost everyone's portfolio. Low cost, broad diversification, historically strong long-term returns, and zero ongoing decisions required.
Investment number 5, real estate. Real estate means buying physical property, a single-family home, a duplex, an apartment building, a commercial storefront, with the goal of generating income, appreciation, or both. How you make money from real estate? 2 primary ways. Cash flow, rent paid by tenants, ideally exceeding your mortgage, taxes, insurance, and maintenance costs every month. Appreciation, the property becoming worth more over time as the local market grows. There are also meaningful tax advantages. You can deduct mortgage interest, depreciation, and operating expenses, which can significantly reduce your taxable income from the property. The real risk? Real estate requires real capital up front, a down payment, closing costs, often $20,000 to $80,000 or more depending on your market. It also requires ongoing effort. Tenants who don't pay on time, repairs that show up at the worst moment, vacancies between renters. Unlike a stock you can sell in seconds, selling a property can take months and involves real transaction costs. Bottom line for working Americans? Real estate can build significant wealth, but it's not passive and it requires capital most people starting out don't have yet. For many working Americans, this becomes accessible later in the wealth-building journey, often after the foundational accounts, 401k, Roth IRA, index funds. If you want real estate exposure without the down payment and the 2 a.m. phone calls about a broken water heater, that brings us to the next one. Investment number 6. REITs, Real Estate Investment Trusts. A REIT is a company that owns, operates, or finances income-producing real estate. Apartment complexes, shopping centers, warehouses, hospitals, data centers, and you can buy shares of that company through a regular brokerage account exactly like a stock. How you make money? REITs are legally required to distribute at least 90% of their taxable income back to shareholders as dividends. That means REITs are well known for paying significantly higher dividend yields than typical stocks, often 4 to 7% annually, sometimes more. The real risk? REITs tend to fall when interest rates rise because higher rates make their dividend yields comparatively less attractive next to safer options like bonds and high-yield savings accounts. They can also be sensitive to the specific real estate sector they're exposed to. A REIT focused on office buildings faced real headwinds during the shift to remote work, for example. Bottom line for working Americans? REITs give you real estate exposure with stock-level liquidity and no landlord responsibilities. You can buy a REIT inside a Roth IRA or 401k, just like an index fund. Worth considering as a slice of a diversified portfolio, not usually the whole portfolio. Investment number 7. Cryptocurrency. Cryptocurrencies like Bitcoin and Ethereum are digital assets that exist on a blockchain, a decentralized public ledger maintained across a network of computers rather than controlled by any single government or bank. How you make money from cryptocurrency? Price appreciation. You buy a coin hoping its value rises over time as adoption, demand, or scarcity increases. Some early Bitcoin investors saw extraordinary, genuinely life-changing returns. The real risk, and I want to be direct here, I am not going to pretend crypto doesn't have real upside potential. It clearly has for some people in the past, but I also need to be honest about what I've seen, including in my own life. I mentioned in my Side Hustles video that I tried crypto trading, and it stung enough that I wouldn't even say the number out loud. Crypto is extremely volatile. Prices have swung 20%, 30%, even 50% in a matter of days during major downturns. There is real regulatory uncertainty. Governments around the world are still figuring out how to treat these assets, and future rules could meaningfully impact prices. And, unlike a bank account or brokerage account, if you lose access to your private keys or digital wallet, there is often no customer service number to call. The money can be gone permanently. Bottom line for working Americans, if you want exposure to crypto, treat it as a small speculative slice of your portfolio, money you could genuinely afford to lose entirely, never your retirement foundation, and never money earmarked for bills, debt payoff, or your emergency fund. Investment number 8. Commodities. Commodities are physical raw materials: gold, silver, oil, natural gas, wheat, coffee. These are the literal building blocks of the global economy, and their prices move based on supply, demand, weather, and geopolitical events. How you make money from commodities. Many investors use commodities, particularly gold, as a hedge against inflation. When the value of the dollar declines, commodities priced in dollars often hold or increase their value. Commodities also tend to move somewhat independently of stocks and bonds, which can add diversification to a portfolio. The real risk: a drought, a war, a sudden policy shift, any of these can send commodity prices sharply up or down with little warning. Direct commodity investing often requires specialized exchanges or futures contracts, which are complex instruments that most beginners shouldn't touch directly.
Most regular investors who want commodity exposure do it through a commodity-focused ETF rather than buying physical barrels of oil. Bottom line for working Americans: not a beginner-friendly category and not necessary for most working Americans building a long-term retirement portfolio. If you're curious, a small allocation through a gold ETF is the most accessible entry point, but this isn't a foundational holding for most people. Investment number 10. Options and derivatives. Options let you buy the right but not the obligation to buy or sell a stock at a specific price within a specific window of time. A call option means you're betting the price will rise. A put option means you're betting it will fall. How you theoretically make money. Options use built-in leverage, meaning a relatively small amount of money can control a much larger position, which means gains can be amplified significantly compared to simply owning the stock outright. The real risk, and this is important, that same leverage amplifies losses just as dramatically. Options are time-sensitive. They expire, and if your prediction doesn't play out within that window, the option can expire completely worthless. You can lose 100% of what you put in, and in some strategies, more than your original investment. This is genuinely advanced territory. The people who consistently make money trading options are typically professionals with deep market knowledge, sophisticated risk management, and full-time attention to their positions. Bottom line for working Americans. I'm including this for completeness because you'll hear the term thrown around, but for the vast majority of working Americans trying to build long-term financial security, options trading is not where your time or money belongs. This is a casino for people who deeply understand the rules. Most people don't. Investment number 10. CDs, or certificates of deposit. A CD is one of the simplest, safest investments that exists. You deposit a set amount of money at a bank or credit union for a fixed period, typically 6 months to 5 years. In exchange, they pay you a fixed, guaranteed interest rate. At the end of the term, you get your original money back plus the interest. How you make money. Guaranteed, predictable interest. CDs are FDIC insured up to $250,000 per depositor per institution, meaning your money is protected even if the bank fails. The real risk: that trade-off for that safety is lower returns compared to stocks, bonds, or real estate. CD rates can also be higher or lower than a high-yield savings account, depending on current rates and a specific term. Worth comparing both before locking money away. And if you need that money before the CD matures, you'll typically face an early withdrawal penalty that reduces or eliminates the interest you've earned. Bottom line for working Americans: CDs are a reasonable place for money you know you won't need for a specific period and want zero risk on, but they shouldn't be where your long-term retirement growth happens. For your emergency fund, a high-yield savings account usually offers similar or better rates with full flexibility. I covered this in my emergency fund video.
Investment number 11. Private equity and venture capital. This involves investing directly in private companies, businesses not traded on public stock exchanges. Private equity typically targets established businesses needing capital for expansion or restructuring. Venture capital targets early-stage startups with high growth potential, often in tech or biotech, betting that a small percentage of them will become massive successes. How you make money? If the company eventually sells, merges, or goes public, early investors can see extraordinary returns. This is genuinely how some of the largest fortunes in modern history were built. The real risk: most startups fail. Your money is often locked up for years with no way to access it before a sale or IPO happens, if it happens at all. And critically, these investments are almost always restricted to accredited investors, meaning you typically need a net worth above $1 million or annual income above $200,000 to legally participate. Bottom line for working Americans: for the most people watching this video, private equity and venture capital simply aren't accessible yet, and that's okay. This category becomes relevant much later in a wealth-building journey, if at all. It is not something to chase early. Bonus: art and collectibles. Fine art, rare sneakers, vintage watches, trading cards, these fall under alternative assets. Their value comes from scarcity, demand, cultural relevance, and the prestige of ownership rather than cash flow or earnings. The real risk: these markets are illiquid, Finding the right buyer can take significant time, and prices are subjective rather than tied to predictable financial metrics. It also requires real specialized knowledge to tell what's genuinely valuable versus what's just trendy hype. Bottom line for working Americans? Fun if you're genuinely knowledgeable and passionate about a specific collectible category, not a retirement strategy. How to actually build your portfolio from this list. 11 investment types. Let me make this simple because that's the whole point of this channel. For the vast majority of working Americans, here's the realistic priority order. Foundation. This is where almost everyone should start and stay for years. Your 401k up to the full employer match, then a Roth IRA, both invested primarily in low-cost S&P 500 or total market index funds. I've covered exactly how to open and fund both of these in previous videos, links in the description. Stability layer, added as you build wealth or approach retirement. Bonds, gradually increasing as a percentage of your portfolio as you age, and a high-yield savings account or CD for money you'll need in the near term. Optional growth slices, only after your foundation is solid. Individual stocks, REITs, or a small crypto allocation kept intentionally small, money you can genuinely afford to lose without it affecting your life. Advanced or inaccessible for most right now. Real estate, which requires capital, private equity and venture capital, which requires accredited investor status, options, which requires deep expertise, commodities and collectibles, niche, specialized knowledge required. You don't need all 11. You need the foundation solid first. Everything else is optional seasoning on top of a meal that's already complete without it. I think about that conversation at 24 a lot. I have a savings account, said with complete sincerity. No idea how far behind that put me. Nobody handed me this list. I had to learn each one of these the slow way, usually after making a mistake first. You didn't have to learn it that way. You just watched the entire list in 20 minutes. That's the whole point of this channel. Carol explained the 401k to me in 10 minutes at the office. My Uncle Walter never got that conversation, not once, in 41 years. The gap between those two outcomes is information, not intelligence, not luck, not starting capital. You now know what a stock is, what a bond is, what an index fund is, what a REIT is, what to avoid, and where your money should actually go first. Use it. Drop a comment and tell me which of these 11 did you not fully understand before this video. I want to know which ones are most confusing so I can go deeper on them in future videos. Like this video if it finally made all of this make sense. Subscribe for more every single week. And if you haven't watched them yet, go check out my videos on the Roth IRA, the 401k, and the S&P 500 index fund. Together with this one, you now have the complete foundation most working Americans need to start investing with real confidence. I'm Chris. Take care of yourselves, and I'll see you in the next one.